What's up, YouTube? It's your boy Steve from Printing Gang Investments, back with another video. And the topic of today's video is a question people have been asking for a minute, especially the haters. You know, in the market, we get a lot of mixed opinions. You can't beat the market. The greatest hedge fund managers can't beat the market. But if you was to actually, look at CNBC articles, look at investor reports from the past few years, retail's actually been outperforming hedge funds for, I think, maybe the past 5 years, decade, maybe even 15 years at this point. And that goes against traditional wisdom. That's why I made my channel. I don't have the most money in the world, but most years when the market do good, I make more than that. You see what I'm saying? And a lot of years when the market do bad, I'll be down a little more, but I bounce back because I'm able to hold. And that's what I'm gonna bring this point to. You know what I'm saying? I often hear people talk about like the bet Warren Buffett made back in the day when he bet the top hedge funds in the world that they couldn't beat the S&P 500 index. And I think he won that bet, and that's cool. But why is it that they couldn't outperform the S&P, but a lot of retail investors have? And I'm not saying all retail investors have. What it boils down to is the obligations of these funds. And that's why when I see people like strictly follow like major investors, like hedge fund managers, like the Warren Buffetts of the world, the Bill Ackmans of the world, the Stephen Cohens of the world, I know they amateurs, because what people don't realize is those larger investors, they make financial decisions for different reasons than me and you would make financial decisions. And a lot of them are do as I say, not as I do type people. Like Warren Buffett, for example. He tells the average investor, invest in the S&P 500. Yet he does everything except invest in the S&P 500. He tells people don't buy stocks that don't pay a dividend a lot of times, or a lot of investors that follow his ideology say that. But Berkshire Hathaway doesn't even pay a dividend. You see what I mean? So it's one of those things if you actually listen to Warren Buffett's interviews, he actually said that he tells people to buy index funds because they don't know what they're doing. If you know what you're doing, you should probably be overweight. Kind of like we did with Palantir and we did with tech stocks before that. If you really understand the business, you really understand what's going on with what you're doing, you should probably go overweight. Even Warren Buffett would tell you that. He said diversification is for people who don't know what they're doing. And, they don't play that clip a lot. But if you listen to that, you'll understand what I mean. And what's going on, what people don't understand is you can look at an opinion of a major investor and factor that into your own opinion, but I would never move like Warren Buffett moves. I never buy stock because Warren Buffett bought the stock. I never buy stock because more recently, who just bought something like, I think if I'm not mistaken, it was Bill Ackman just bought Hertz. I'm not finna buy Hertz just because Bill Ackman bought Hertz. He have a billion reasons for buying Hertz, big dog reasons that we not even understand. That's an activist investor. He got on the board of everything. You see what I'm saying? So what people don't understand is it's easier for a retail investor to outperform the market than a larger investor because we don't have the obligations as them. One reason you can't follow a lot of these bigger investors, they have more money to invest. So someone like Warren Buffett, he can't just buy any company because he got so much money, he'll buy the whole company for real. So he can only invest in things that's it's large enough for him to invest the chunks of money he wants to invest. And he's more concerned with like capital preservation than growth. And it makes sense because what people don't understand, a lot of the companies he invested in, they weren't growing. I would look at like when Warren Buffett was probably buying Coca-Cola and Apple. I mean, not Apple, but Coca-Cola and all these value stocks back in the day. They were, more closer to an Apple or an Nvidia. Like those were 50-year-old companies, 30-year-old companies, 40-year-old companies. They weren't the 100-year-old companies we know today. And he called a lot of growth wave. But what people don't understand is hedge fund managers have to make a return every year or they lose clients. So like right now, we going through this crash. They got decisions to make. They got to sell. They can't hold a stock that they know could draw down 40, 50, 60% because they're going to have to pass that off to the investors at the end of the year. and they're judged on a year-by-year basis. Their bonuses is judged on a year-by-year basis. So you can't even always sell when they sell. And they also have to hedge. Like, I know y'all see me on this channel with my train. When it got real, y'all see me buy puts too sometimes. Well, they got to do that even when things ain't real. They got to do that when the market's going up. So when the market's going up, they're going to be losing money while they're making money. Like, same way, I do it the other way around. When I lose money, I try and make a little money while I'm losing money. They don't mind losing money while they're making money. So if I got a hedge fund and I got an obligation to be long a certain amount of stocks, be short a certain amount of stocks, when the market start riding, I'm losing on them shorts. So that's going to drag down my return. The average retail investor is not doing that. In addition, we don't have to worry about the weight of our positions. Like, none of us, for the most part, unless you got someone out here worth hundreds of millions of dollars, our position's not going to move the market. If you buy $100 worth of stock, that's not moving the market. $1,000 worth of stock, not moving the market. $10,000, $100,000, even $1 million worth of stock, not moving the market. $5, $6, $7 million worth of stock, probably not moving the market. So any type of money that a retail investor would be dealing with, even a rich retail investor, is not necessarily moving the market like that. When you're talking about like big hedge funds, big investors, when you're talking about multi-$100 million positions, that moves the market. So they can't get in and get out as fast as we can because of that. So they can't just get on a chart and buy something at a level, because if they buy it at a certain level without doing it with algorithms, without doing it in dark pools, this is the way they do things, but without doing it the way they do things, they were just to just buy stock the way we buy it. You just see a major green candle on the chart and everybody would just buy and the price would be high, and for the person putting in that order, they would end up paying a higher price than they want, because we see it going up, we would buy it, we would push the price higher, and they would have to buy at a higher price. So they have to make different moves than we do, and that's actually an advantage. The advantage they got is they're way, way richer than us. They got hundreds of millions of dollars, billions of dollars, tens of billions of dollars. The advantage we got is we're so small, it's easier to grow our money. So that's why we're able to outperform a lot of these funds and managers. Another thing is, all right, let's say the market crashes this year, for real. Let's say Palantir go back down to 40. Let's say Nvidia go down to fucking 60. Let's say Tesla go down to 100. Let's say let's see who else. Let's say Apple go down to 120. Let's say market crash. S&P down 30% on the year, 27% on the year, something like that. All right, hedge funds, they're gonna have to go short. They're gonna have to sell a lot of positions. They're not gonna necessarily be able to hold a lot of things like they need to. Us as retail, we can be long, we can get hit up on our positions, and we can just buy more when our paycheck come in, buy more when we trade, buy more, hold. We don't have anybody to report to at the end of the year. So like right now, the reason a lot of retail is making a lot of money, because when 2022 happened, hedge funds and a lot of institutional managers had to sell out of tech because tech was crashing hand over fist. If you was there in 2022, you know what I'm talking about. Meta got all the way down to $80. So they had to get out, only for it to turn around and hit all-time highs 2 years later. So retail, you know, if you was smart, you held, and that's why they always tell you to hold through these drawdowns. If you was one of the people who held through those drawdowns, and if you added, you got rich. Like, before the 2022 crash, Palantir got all the way up to like $40, but it was hanging out like the $20-some range, $25-some range, trying to get back to 30. Market crash, they knock it all the way down to $8 for real. That's when we started loading up, and that's when we bought I bought like almost 500 shares during that period, and that's why we got rewarded so heavy. You see what I'm saying? So as a retail investor, what you got to understand is your advantages and disadvantages versus the bigger institutions. Like, okay, disadvantages we have as retail when we're day trading. If you day trade, you'll know what I mean. Like, the faster you trying to get in and out of a trade, you trying to play with the big dogs' money, because that's what they do. They got the algorithms that get out in split seconds. That's why I be scared of trading bots a little bit, because I know that the bigger institutions have better algorithms. So I'm gonna start, I might start looking into it because we do got AI now, so they say we could build better trading bots. But that's why I'm more a proponent of holding and swing trading, because contrary to popular belief, the institutions aren't really in your way when you hold it and swing trading like that. When you day trading for very short periods of time, you got to deal with the institutions. But even when you day trade, you could avoid that by holding your trades for 30 minutes, an hour, 2 hours. Like, the longer you hold it, the less you got to deal with the algorithm. When you're trying to get in, get out, that's when you start fighting the algorithm. And that's one of the other things people don't understand. So what I would tell investors to do is, retail investors, your main advantage is that you can buy and you can hold and you can do research. And you can buy companies at a lower level than Wall Street's willing to. Like, we bought Palantir at $8. They thought it was overvalued then. Due to the things they reported since earnings, the proper value would be like 20-something, 30-something, 40-something. But we were able to do the research. We was able to get on the ground floor. We was able to see what the business is doing. And we was able to take that chance. Hedge funds aren't necessarily able to do that. And even me, it's chances I don't take. Like, Palantir was probably that size company, like that $20 billion range, $30 billion range, maybe even $15 billion. That's about the lowest I go. I'm not much of a $2 billion company type of person. I don't like to buy companies that small. You might see me trade them. $5 billion company, you might see me buy some options, get some money, but like loading up on shares is not really necessarily my thing. But what people got to understand is the advantages we got as retail and the advantages they got as institutions. Another thing I'll talk about, the information. I hear a lot of, I say, misinformation at this point that, oh, you can't make money in the market because the institutions get data faster than you. Yeah, they did back in the day, but at this point, we got Twitter, we got 5G internet. Like, we got people who have Bloomberg terminals who are tweeting what they're saying as soon as they get the data. So there's not much of a data gap as there was, like maybe a few minutes, maybe a few seconds, and that only matters when you day trade, swing trade. Now that's still insider trading, but that's above our pay grade. You see what I'm saying? So what people don't understand, that's why I made this channel, is to show people that with whatever amount of money you got, you can get in this market and you can make money. That's why I don't show every account I got. That's why I don't show my whole net worth, because it's not about how much money I'm worth. It's about just whatever money you got, you can grow it. Whether it's $100, $1,000, $10,000, $100,000, million. But it's your boy Steve from Printer Gang Investments. You know what I'm saying? I'm about to get back to giving y'all content. I just want to, give y'all a little talk. And I'm going to see y'all in the next video.